Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Masser and Tim Stenivek on Bloomberg Radio.
After the U.S. election, when Wall Street was all in on the prospects of a business-friendly President Trump, Peter Berezin was sounding the alarm. He and his team at the research shop BCA predicted that broad-based unilateral tariffs were coming and that the new administration's proposals would go well beyond what had been implemented in Trump's first term. He was right, and now he says we've got a long way to go, lower, before the end of the year. In other words, the worst is yet to come. Peter Berezin is Chief Global Investment Strategist at BCA Research. Their clients manage some $34 trillion. He's featured in one of the most read stories on the Bloomberg in the last 8 hours. He's based in Montreal, Canada. Peter, welcome to the program. You've got a 44.50 call on the S&P 500. We're at about basically 5,100 right now, so roughly 15% decline from where we are. Why are you so bearish?
I don't think the stock market has yet fully priced in a recession. I mean, keep in mind that up until a couple of days ago, the 493 S&P companies that are not the Magnificent Seven were still actually up slightly for the year. And these are generally cyclical companies that one would expect to go down in a recessionary scenario. So we're starting to see that being priced in, but we're not there yet. To get down to 44.50, which is my target, you don't need to make any wild assumptions. All you need to assume is that the forward P multiple drops to 18 and the earnings estimates fall by 10 percentage points. That's not crazy at all. On average, between 2015 and 2019, the P multiple was 16.8, and I'm talking about 18 in a recessionary scenario. So if anything, my target, even though going into this year it was 1,500 points below the nearest person, might actually turn out to be a little bit too bullish.
Could we even go lower than that?
We certainly could go lower than that. I think it would require a deep recession, but we could get a deep recession if policy continues to be very unfavorable. And I'm not just talking about tariff policy. We also have kind of this discussion of the Mar-a-Lago Accord, this idea that perhaps holders of Treasury bills will be forced to roll their money over into low-yielding long-term bonds. I mean, this is crazy, right? The Treasury market is the ultimate risk-free asset. If we undermine the sanctity of the Treasury market, then we're looking at a worse financial crisis than what occurred in 2008.
This was supposed to be the year.
Wait, you said we could. Sorry, Tim.
Hey, go ahead.
I remember living through 2008. I know you did too. And I just remember,
you talking to me?
Yeah, I'm talking
did.
to you. I mean, Peter, we thought the financial market system globally was coming down. I remember not going to bed because headlines were crossing and it was like which Wall Street firm was being bought by whom and which one wasn't going to make it and so on and so forth and what the government was going to do. Say that again so that we understand kind of the heft of what you are saying.
The fact that the dollar is weakening now is very, very unnerving because the dollar is supposed to be a risk-off currency. You buy treasuries when everything is going to hell, and that requires more dollars, and that pushes up the value of the dollar. The fact that the dollar is weakening now is telling you that increasingly investors are losing confidence in the U.S. financial markets. And, you know, President Trump wants a lower trade deficit. The mirror image of a trade deficit is a capital account surplus. Yeah, if foreigners decide that they don't want to hold U.S. assets anymore, that's going to drive down the value of the dollar. That'll make imports more expensive, make exports cheaper. That'll result in a lower trade deficit. But we're talking about something that will also entail a huge decline in stock prices and probably a financial crisis.
So not exactly making America great again.
Not quite, no.
It raises the question about how much damage can be done before you believe that Trump will reverse his policies, if that is something you believe.
Well, I think for one thing, we've already sort of passed the event horizon. I think at this point, it's going to be very difficult to avoid a recession just based on everything that's already happened. The economy wasn't that strong going into the latest escalation of the trade war. In February, real wage and salary income was only up 1% year over year. The CPI swap market is telling us that these tariffs could push inflation to well over 3%. We're potentially looking at negative income growth. That's going to be very difficult to maintain without the economy weakening significantly and spending drying up. So I think the outlook is quite worrying at this point, and it's probably too late to avoid recession. And I don't think that Trump is willing to reverse course anyway. He's been very, very clear, really for like 30 years, about how he wants to build this protectionist wall around the US. I don't understand where this groupthink came from, where people were just saying, oh, it's going to be a negotiating ploy. It's not a negotiating ploy. He wants something that resembles autarky.
Okay.
We're going to pick up on that, but we got to do a headline.
There's a headline crossing the Bloomberg terminal, and I'm going to work it into a question here. eToro is said to delay its IPO roadshow amid market volatility. Put that on the list of companies that we've heard from today or have been reported on putting their IPOs on hold. StubHub, Klarna, AdTech Group, MNTN, Insure, Integrity Specialty Holdings, Chime as well. Are you concerned that we're seeing financial conditions tighten too much right now? We could start to see some sort of panic or freeze?
Yeah, we estimate that easing financial conditions last year, mainly because of rising stock prices, added around 0.5 percentage point to growth. The fact that financial conditions have tightened, mainly because stock prices have fallen, credit spreads have widened, is based on kind of a very back of the envelope calculation, will shave around 0.5 percentage points from growth. And that's not huge, but the risk is that you get kind of in this feedback loop situation where stocks go down. That means people feel less wealthy. That means they spend less. So there's less sales, less profits, and even lower stock prices. That's what we often see during recessions. And I think that's what we're starting to see now.
You know, I'm looking at something I think you either said or shared with MarketWatch, and this was around late March 21st, and that even though you had this outlook for the S&P 500 this year of 4450 by the end of the year, and I think when you compared it to anybody else, it was the lowest on the street, you did have 5 scenarios that could boost stocks this year. And you talk about the president, walking back much of his tariff agenda, kind of caving to pressure from the market and a few other things. Do you still believe that there are scenarios where the market could actually rally?
There's certainly scenarios, and I wouldn't be surprised if over the weekend there's some comforting words from the Trump administration, but that's not my base case. I think that probably the trade war gets worse rather than better, because Donald Trump kind of had this, I'd almost say like naive idea in his mind that he's going to raise tariffs, and that's going to force other countries to reduce their tariffs. Well, there's 2 flaws with that argument. The first flaw is that most rich countries don't actually have very large tariffs against the U.S. and don't really have very large non-tariff barriers against the U.S. I mean, they have regulations. All countries have regulations, but they're not specifically targeted at U.S. companies for the most part. There's going to be exceptions, of course. So there's not a lot that other countries can do anyway. And the second thing, which is more politically relevant, we've seen, this is certainly true here in Canada, that retaliation is politically popular. Donald Trump has single-handedly resurrected the Liberal Party, which was heading for a huge defeat in the elections. And so people are saying, well, wait a second, if we can get more votes by retaliating, we'll retaliate. And so we're not going to get countries acquiescing to Donald Trump's demands. We're going to get retaliation, and that could very well spark another round of tariffs.
One of the things I also wonder is that, is it possible that, this, I guess what I'm thinking about is what you said before, autarky. And that is the idea that, right, the U.S. produces everything that we need within our borders. Is that really, you think, the goal of President Trump? Because I think that's one of the things that we've tried to figure out with the tariffs, is that what's really his end game? What's really his mission here? But do you believe that his mission is that the U.S. is kind of self-sufficient in providing everything it needs for its citizens within its borders and then cut down trade?
I think Donald Trump sees trade as a zero-sum game, meaning that if one country is running a trade surplus with the U.S., then somehow that country is exploiting the U.S., ripping the U.S. off, as he likes to say. He doesn't see trade as something that can lift all boats, which is the way most economists see trade, nor does he kind of realize that the reason the U.S. has this trade deficit is because the U.S. has been a very good place in which to invest. Rather than buying U.S. goods, foreigners have been buying NVIDIA stock or treasuries. That has been a vote of confidence in the financial system. And if you force people to not buy U.S. assets, you'll have a weaker dollar and a lower trade deficit. But is that really what you want?
Hey, you mentioned politics a little earlier, at least from the Canadian perspective. Here in the United States, I'm wondering the sort of guardrails that you see on this president and his policies, because we're getting news now that Senator Ted Cruz, who's usually a staunch supporter of President Trump, sounded the alarm on the administration's move to ramp up tariffs, saying they pose, quote, enormous risks to the U.S. economy and make Republicans vulnerable to a, quote, bloodbath in next year's midterm elections. He said this stuff on his podcast, which was released today. This from our team at Bloomberg News. How do you see the guardrails around this president here?
So I think that's going to be what happens next. You're going to see more and more Republicans abandon Trump, and we're going to have real discord within the Republican party. But unfortunately, the way the system works is that Trump does have a lot of discretion over tariffs. And unless his popularity plunges, and I would say it's come down, but it hasn't plunged, he's not going to change direction. I mean, realistically, if you spent a month talking about Liberation Day and then say, oh, wait a second, the stocks have gone down, just kidding. He can't do that without looking really foolish. And so he's not going to do that unless there's a lot more pressure. We're just not there yet.
Hey, one thing I want to ask you. All right, so if we buy what you're saying about 44.50 by the end, and it looks, certainly possible considering what we're going through right now, where are you investing or suggesting investors suggest this money? You guys advise a ton of advisors, share your research. Where would you be putting money in this environment? Or is it too late to move anything around right now?
I think it still makes sense to have a defensive bias in one's portfolio. That means holding more cash than one otherwise would hold. It means holding more bonds, though there's, of course, risk around bonds given the large fiscal deficit and the whole Mar-a-Lago Accord discussion. But nevertheless, the Fed probably will be forced to cut rates quite aggressively, more than what the market is pricing in. So you want to have more fixed income, less equity. Within equities, you want to own more staples, healthcare, these defensive sectors. And you probably also want to own a bit of gold now. I think that's a true safe haven asset.
What would you say to folks out there who are tempted to buy this dip?
Listen, I mean, if you're nimble, you can, of course, do it. But I wouldn't buy it with the expectation that stocks have bottomed. I think we could get a rally that lasts for a few days, perhaps even a few weeks. But ultimately, if we end up in a recession, and I think that's where we're heading, earnings estimates are going to come way down, and that will drag stocks down with them. So I think it's too early to move to an overweight stance on stocks.
Well, it's like we like to remind everybody, markets don't just go up. They don't go in one direction. They go up and they go down. Hey, Peter, thank you so much. Double duty. We know you spend some time with our TV colleagues as well. Glad you could also spend some time with us as well. As we said, this story by our Vildana Hyrick, it is one of the most read stories on the Bloomberg. Peter Berezin, he's Chief Global Investment Strategist at BCA Research, joining us from Montreal, Canada. Peter, thank you so much.
This is the Bloomberg Business Week podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Liz McCormick is chief correspondent for Global Macro Markets, joining us from New Jersey. Liz, you've had so much reporting out there. I'm trying to figure out where we want to start because, you know, what was interesting is I thought what Alex mentioned about what we saw in the bond market this week versus what we saw in the equity markets doesn't match up. Much more a negative tone in the equity trade. What is the Treasury trade telling you today after the week that was?
Yeah. And I was listening to you guys talk and I heard Alex's points. I think in some ways, like if we look back, remember some days, intradays, it was like across the board. Each tenor in treasuries was down over 10 basis points. So we had some decent moves. We've kind of come back today. I'll talk a little bit about that later. But I think I was going to say bigger picture. If we step back, remember how far we've come that, you know, the 2-year note yield is down almost a percentage point from the highs of earlier this year. 10-year note, it seemed like couldn't crack 4% and it did. Now it's just trading quite, you know, hovering near there. So I think the Treasury market has done it. I mean, if you look at the IN page for us, our indices, the U.S. Treasury index is up about, I think the last I looked as of yesterday, about 3% for the year. So it's kind of been doing its job. You have seen that flight to haven. It's just the superlatives, like you say, in these other markets from stocks to what worries me, even though my you know, main area is sovereign, what I really watch is credit risk, right? And like you mentioned, we have these CDS widening, junk bond spread widening, all these other things, people pulling deals. That's where I worry that, like you're saying, it depends if President Trump really ends up negotiating. But certain things you can't put the genie back in the bottle, right? If credit risk keeps going and then we get this hidden leverage, which is always like something that's lurking. If people start, you know, losing on positions and leverage, things start cracking, you can't fix it that quick, right? So that's what I worry about. Yeah,
I am looking at the IN page. U.S. aggregate up 3.6%. Is that what you're talking about? Yeah, I mean,
yeah, exactly. Yeah.
Wait, say the page one more time for the Bloomberg subscribers.
I love that page. IN go, easy in, right? It's all our indices. And you can look at all the fixed income indices. And so that's at least good that, you know, if you're in a portfolio, you're talking about your retirement, 60-40, at least the bond side has worked for you. So you have some gains where you're getting crushed in your stocks. But yeah, I think, you know, today, let's talk a little bit, I mean, maybe you have a lot, but about Chairman Powell. Like, he was very calm and I feel like led with inflation, right? Yes, the tariffs are bigger than we thought. Of course, he mentioned it would hurt growth, but he seemed very clear that they don't want inflation expectations, public inflation fears to kind of take off. So he was like very like, we have time to wait. So he
seemed very calm. I mean, Jay Powell was a very measured, mild-mannered person. I don't know him personally, but it seems like...
Oh, come on. You can share that Dead concert you went to together.
I actually want to go for a bike ride with him, but that's neither here nor there. I think that would be a fun thing to do. But it does make me ask you, Liz, given his comments earlier today, did it seem to you that he was really calm about saying, hey, we've got time here?
Yeah, I want to say that I had a feeling, and people I think thought I was crazy, that like, even though the market, let's say the swaps market pricing and Fed cuts was really kind of getting over its skis, pricing in almost 5 cuts this year. I said, let's be wary that Chairman Powell, because that's his job. He has a dual mandate, right? And like you're talking about, everyone's cutting their their growth forecast. Simultaneously, they're lifting their PCE forecast, right? So this is, I hate to use that word, this is a stagflationary thing. So the Fed kind of never got, I don't want to fault them, but inflation hasn't like sustainably got to their 2% target after the pandemic. They did a lot of great stuff and it's down. So I think he's very weary because he knows if you let that inflation genie out of the bottle, that's the worst problem for them. So I think that's why he was very measured and calm. And we will see. Like we had yesterday we had some economists saying no cuts, some saying 5 cuts. It's like all over the place. So I think they're waiting to see. But Powell was very calm.
Well, one thing I want to ask you too is you always check in with all the trading desks, the global, fixed income bond trading desks around the world. Were people kind of freaking out? Were people saying, yeah, we've got a global recession coming? I mean, it's all interconnected, right? It's not just, even if we are pulling back on global trade, I mean, what happens here is going to matter what happens in other countries. I mean, it's important. So I'm just curious, what was the tone, Liz, that you were hearing?
Yeah, I would say like overall for investors, I mean, again, it's a bunch of superlatives, but this, even though we had the stories about Mar-a-Lago and we thought, think Trump will go out of the box, I do think, Carol, many investors feel like this on trade is a seismic change, right? He's trying to reorder everything, right? And he said, Trump has said he's willing to take some pain, but they didn't realize, I think everyone keeps saying to me, Liz, we knew there would be quote unquote reciprocal, but not by this math that they pulled off, right? That was much higher than they thought. So I think that's what everyone said. It's worse than I thought. I will say Dan Iverson of PIMCO was kind enough to talk to me today. And he's, they've been warning for a while that, hey, this tariff is a risk and just to be cautious. And but he said that what President Trump rolled out was a little more hawkish than they even expected. So I think everyone was taken by surprise at how kind of stringent the tariffs were.
All right. So there is that. Is there also an expectation, Liz? I mean, this came up in a lot of our conversations today, is that the expectation is just like we're seeing with Vietnam already, right? Lululemon rallied, Nike rallied. There were names that rallied because there is that expectation that these countries are going to come back and negotiate. Is there in the investment community the same feeling?
Yeah, I mean, I had a few say to me, like hope is not a plan, even though they hope to see this. And like you said, there was the positive signs on Vietnam, although China kind of came in hard. The EU has said, and we have stories on that they're hoping to negotiate. So I think there is some hope that this doesn't turn out to be as bad as it seems at the moment. But then we have President Trump coming out on social media kind of saying, hey, my policies are stuck. So I think people are very kind of on Tinder hooks. They're not sure.
But let's play that out for us, Liz, a little bit, because I think that is sort of the optimistic view here, that this could be an opening salvo. And we could see a situation like we got a little preview of with the Vietnam news earlier today, where we did see stocks bounce a little bit off of their lows as a result of that post from the president who said the country is, wants to take their tariffs away. If that is indeed the case, it still sets up for quite a bit of uncertainty. And we know that what executives don't like is uncertainty. They want to be able to plan where their next plant is going to go. They want to be able to plan who they're going to hire for the next year. And if these things can get implemented and then pulled on such short notice, I think that could create a challenge for these companies.
Yeah, I 100% agree that, even if there's some negotiation, I don't think also, Tim, that anyone thinks that there'll be a wholesale reversal. President Trump wants a more tariff-heavy policy, right? So even if the worst of this is dialed back, it's still very different. But I think you're right. Many companies are saying, how can I put out a big investment? I don't want to sell new debt now. I'm not going to add to my hiring, all these things, because like we always say, but it's true. Uncertainty is the worst thing. And when I was trying to do the coverage right after, and we were figuring out what's going on when President Trump gave his speech on Wednesday, the quick thing from a lot of people, even after we got the full chart, is we thought we were going to get full certainty and now we don't, you know what I mean? And I think like even on the negotiation, people don't know. And I want to bring in maybe you've been talking about this all day too, so sorry if so, but like, let's think about there's the tariffs and then there's the wealth effect. Carol, you were joking about your retirement.
No joke.
I told Carol, I wasn't joking. I told Carol, maybe this is a night when she goes and orders the pizza, not to get toppings.
It's real. I mean, it's real. You start to say, well, or somebody was going to switch jobs, maybe not, at the margin. I mean, maybe this is like soft data, so to speak, but your retirement account is real. And even non-retirement, I've got young 20-some kids looking at their portfolios. So I think everyone, it feels a little less rich. And that does factor into whether you're going to buy that new thing. So again, even if slowly some of this gets negotiated down, those factors, I don't think the stock market will be jumping. We're not buying all the dips now, right? So I think it's a little bit of a longer process. So I hope we don't get things that break. Leverage comes out, the basis trade blows up, all those things that once that gets going, it creates some more kind of systemic issues.
Well, that's what I think about. What's most vulnerable right now, Liz, in this environment? Because I do think about that. The idea of stopping something versus starting it up. Stopping it can be easier than getting it going again. And I think about the economy and what could be some of the lasting impacts of this tariff policy, especially as you say, this is something President Trump has been behind for a long, long time. And it doesn't feel like he's going to roll back so easily. Even if he pulls back a little bit, it's still going to be there. And I do wonder about the longer term impact on the U.S. economy here.
Yeah, and I think these hidden things are that, remember, we all lived through 2019. We haven't had a repo issue like seismic now, but leverage. There's things, when people start losing money and you get margin calls on different things, then you start selling things that you can. And that stuff you don't, it's like you don't see coming all the time, right? Mm-hmm. And that creates issues. And then, like you said, even like liquidity in markets, when that starts to break down, mm-hmm. And that's what the Fed is concerned about, market structure. But overall, remember, we were like, before all this, maybe we're going to get through this with this rare thing of no recession. Fed tightened all this way, and now they dialed back and no recession. Now let's say the worst of the Trump tariffs aren't laid out, but like you both said, that still structurally there's tariffs. Who is it? JP Morgan saying if this continues, we get a 60% odds of recession. It just seems like the recession case, even if it's not in this cataclysmic near depression, people are sometimes saying globally now, that slowdown we thought we'd avoid, that, economics recession, we may have it, right? So that's enough to kind of keep the edge off stocks and other things.
We've already seen sentiment, consumer sentiment pulling back. We've seen business spending pulling back. So just watching all of these indicators. Liz, this was such a great deep dive. Thank you. So appreciate it. Have a great weekend. Liz McCormick.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
Just before we came on air, we got the news that President Trump has said that he's decided to extend the deadline for Chinese firm ByteDance to divest TikTok's U.S. operations and give his administration more time to finalize a plan to keep the popular app running in the country. Trump said he will give Beijing's ByteDance an additional 75 days. Remember, it was April 5th was going to be the deadline, this deadline.
And
there've been others.
Let's not forget it. It stopped working for a while, right? It was shut down in the U.S. for just a beat. It's just
but then we had to get it back. Snoopy and Charlie Brown and Lucy. Was it Lucy that always pulled the football out? That's what it feels like constantly. Sorry. TikTok football. All right, go on. I think you're right. They were supposed to agree to this deal that would sell TikTok's U.S. operations to an American buyer and avoid a ban that was set to take effect as soon as this weekend. For more, we want to bring in Michael Shepard, Senior Editor for Technology and Strategic Industries at Bloomberg News. Also, Kurt Wagner joins us. He's Bloomberg News technology reporter. Kurt is also the author of Battle for the Bird, Jack Dorsey, Elon Musk, and the $44 billion fight for Twitter's soul. Michael, I want to start with you out in Washington, D.C. ByteDance, we got some comments from ByteDance. They've confirmed that the talks are ongoing as Trump announced this extension. What are the proposals right now that are being reviewed?
Well, the one that seems to be gaining the most favor and is viewed as a leading contender would actually not completely wipe out ByteDance as an owner in this new U.S. app that the plan would call for. Instead, what you would see is their holdings diluted to below 20%, and that would allow it to fit within the parameters of the law that Joe Biden signed last year, calling for Beijing-based ByteDance to divest to below a certain point and lower some of the national security risks associated with that. They would no longer have a controlling stake in it. Instead, you would see investors including Oracle Corp, Blackstone, and perhaps Andreessen Horowitz also join in buying up, together with other investors, a 50% portion of this venture. And then ByteDance American investors would buy another 30%. And the idea would be that it would be an American operation, still with some nominal connection to ByteDance, but that in doing so and allowing this ByteDance ownership to remain, that would perhaps make it easier for the company to sign off on the deal and then also win the blessing of authorities in Beijing, which is no small matter.
All right, wait a minute. First of all, I don't even know who to ask. I want to ask both of you. Kurt, let me bring you in. Is there even a nominal connection to ByteDance? Is that even possible? If the concern is about any connection with China and potentially the Chinese government, is that even possible?
So the ownership breakdown that Mike described is possible under the law. I believe ByteDance could own, as long as it's less than 20% of this company, that would be allowed. But what would not be allowed, and where the sticking point is, in my opinion, is on the technology itself and control over the algorithm that people, that is used to show people posts in their feed. So under some of the previously reported kind of discussions and plans that have been floated to Trump, ByteDance, even though they'd have under 20% ownership, would still control this algorithm. And according to the law, that is not allowed. And so ByteDance doesn't want to give up control of the algorithm. The law says they have to give up control of the algorithm. So to me, it's less about the ownership here that's the sticking point, and it's probably the technology and who gets to control it that's the sticking point.
Right, the holy grail that makes TikTok TikTok. Michael, come on back in here. Is that what's kind of making these negotiations tricky? I'm curious what you guys are hearing from the White House, because it is interesting that it's not like we've just said, that's it, TikTok's done. They keep expanding, the timeline here and extending it. So is that what's holding it up, is what's up with the algorithm and who really controls it?
Carol, it's a good question. We don't have that much visibility into what is exactly happening behind closed doors in these talks. But the algorithm certainly is a sticking point. The law was very clear about whether ByteDance or any Chinese entity, for that matter, could remain in control of this really valuable technology that also allows potentially a window into American users and also a vehicle for perhaps disseminating propaganda in the U.S., which was another concern cited by U.S. policymakers when this was passed. So that is certainly one of the sticking points, but there are many others too, including ByteDance, for instance, just overall doesn't like the idea of this sale. They found it objectionable all the way back in 2020 when Trump first pushed the idea. Remember, he originally signed an executive order banning the app, and then set about trying to find a U.S. buyer. Of course, those efforts kind of just fell apart during the pandemic, among other things, and legal challenges too. But for ByteDance, this has from the start been a non-starter. The fact that they're confirming some discussions today is news, and it's really the first we've heard from them saying that they are in talks with the U.S. on this.
Hey, Kurt, who do you think in your reporting is the most serious contender to take over ByteDance's U.S. operations, TikTok's U.S. operations?
Well, I think there's a difference perhaps between who's the most serious and who's the most likely, because I think there are actually a lot of serious contenders, including, Frank McCourt and Project Liberty. I mean, they're very serious about wanting to do this. But do I think they're maybe in the driver's seat? I would say probably not. I think Oracle, maybe to get to the real, point of your question, like who is the most likely? Yeah. I think Oracle is probably the most likely to be involved here for a couple reasons. Number one, we know that they were part of the consortium of investors that was reviewed in the Oval Office on Wednesday by Trump and some of his aides. We also know that they have an existing relationship with TikTok. They already work with TikTok on cloud services, on data storage. And we also know that Oracle Chairman Larry Ellison is a Trump supporter, a Trump donor. And because of those reasons, I think Oracle has sort of taken the lead in terms of who is almost guaranteed to be in a proposal from Trump. Now, again, as Mike pointed out, a lot of this depends on whether ByteDance and the Chinese government ultimately agree, which they may not. But the proposal that Trump puts forward, I think we all expect to have Oracle probably involved.
Michael, one of the things I wanted to ask you is how much of these conversations are also related to the tariffs imposed on China? I'm just curious if it all kind of folds into one.
Well, in the end, we joke here in Washington that it's all one story, and Trump has certainly tried to connect these two issues. The question is whether officials in Beijing share that view, that you can lump these things together. If you're Xi Jinping, for instance, do you think that there is such an easy trade-off between, this company ByteDance that is considered a local star, and then the massive tariffs that Donald Trump has just imposed on so many exports from China into the U.S.? And, is there really something else to be gained here for Xi Jinping by doing one thing or another in terms of this with Trump? Trump has reiterated his offer to China of perhaps lowering tariffs in exchange for getting some help and winning approval for a deal. Now, whether Xi Jinping is willing to do that, let's take a look and see.
Yeah, certainly. Kind of interesting to see what comes next. Hey, just real quickly, Kurt, Amazon, are they out? Are they even a contender too?
They are a contender. They did submit a bid. It's unclear exactly how serious it's being taken, but they did submit a bid this week, as we reported. If I could just make one final point on this about what's happening this weekend. Again, because this executive order was signed to extend this deadline, we presume that TikTok will continue to operate. But you may remember that last time around in January, when there was a ban, even though Trump said, hey, you guys have more time, the tech companies that support TikTok, that put TikTok in their app stores, or in Oracle's case, that provide these cloud services, they were actually worried about following the law and didn't always take Trump's sort of executive order as being good enough for them to keep working with TikTok, right? So we have reached out to these companies. We're asking, hey, do you plan to continue to support TikTok technologically during this time? Because if you're Apple and you're sitting there going, hey, even though Trump says it's okay, a future president could come in and there are massive fines that they could face for breaking this law down the line if they choose to do so. So I think that's something we're going to be paying attention to, is even though Trump says it's fine, do their tech partners believe enough in his word to continue to support TikTok and keep it operational? And we'll only know that, over the next 24, 48 hours if we see whether it goes offline or not.
All right, so 2 clocks ticking, 24, 48 hours. And then, of course, we've got 75 days because of the president's extension to figure out what's next for TikTok in America. Hey, guys, thank you so much. Have a great weekend. Mike Shepard, senior editor for Technology and Strategic Industries at Bloomberg News in D.C., and Kurt Wagner, Bloomberg News technology reporter. He's there in Denver.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
All right, let's get back to the general market environment, business environment, global environment. We've talked about businesses pulling back on CapEx, slowing global growth here in the U.S. And elsewhere. Tariffs, a global trade war, a global market sell-off, not an easy macro environment. And on a day like this, it is easy, as we talked about earlier, to kind of skip over a U.S. jobs report that showed growth exceeding forecasts for the month of March. It was backward looking. So we wanted to get a good gut check on the U.S. macro environment, what he's hearing from companies in the C-suite about the labor market and more. Alan Guarino is back with us. He's vice chairman in the CEO and board services practice at the executive search firm Korn Ferry, joining us from the West Coast. Alan, nice to have you here on a week that's been a little hectic, to say the least. A lot coming at business leaders, a lot coming at the markets. What are you hearing from the business community about the macro environment?
Well, thanks, Carol. It's always great to come on with you and Tim. What we're hearing is, what we've been hearing, other than the last 48 hours of what I think we would all categorize as shock to the system. And so let's just recap. So we had a big jobs number on one hand, then we had tariffs on the other in the last 48 hours. Someone could say a trade war, right? But we had a strong economy going into this, people would argue, and we had low unemployment. So I think the best thing to describe this is that, if I were a CEO today, I'd feel like I was driving a race car with one foot on the gas and one foot on the brake.
Wow.
And I think what that means is that, as much as we'd like to have really solid, smart predictions, I think it's a wait and see. And I think that wait and see is probably in a window of 90 days. Will, U.S. labor be competitive? Should manufacturing be able to return in some measure to our shores? It's just early times right now.
Listen, one thing I want to get to, though, too, uncertainty, no doubt about it. I'm looking at a market that is just getting worse, and we've got about an hour and 15 minutes to go, and we're looking at our major equity averages, Alan, at the lows of this session, something we haven't seen in a long time. S&P 500's down 6%. Dow Jones Industrial Average almost 2,200 points to the downside, down about 5.5%. NASDAQ 100 down almost 6%, down 1,100 points. That does rattle businesses and leaders. Certainly if you're publicly held, you look at your share price. What does this make you stop to, do? What won't you do as a result of all of this?
So, Carol, honestly, go back to Adam Smith. I think he said something to the effect that, understanding history will empower you to know what to do. Let's think back, sadly, to the pandemic. I think we had a 30% peak to trough market move within a very short period of time. The market came back. So CEOs don't usually run their businesses based on the stock market. Yes, they run their businesses based on creating the right earnings, trying to defend their multiples. But I don't think 30, 60, 90-day windows in terms of market reactions to clearly identified outside shocks is going to change that. You're going to have some CEOs, let's just say there's job dislocation in this market. I don't think there will be, but if there was, that means that if some company's cutting back, there's going to be a smart CEO who's going to step in and acquire that talent. Just like, quite frankly, people are going to over the next couple of months, if this market continues to, trade lower, are going to step in and start taking on stock positions that they would have liked to take previously that they felt were overpriced. So with all of this, let's call it somewhat chaotic market activity, it doesn't short-term change the way CEOs run and make decisions, especially on hiring.
So at this point, you're not hearing from CEOs that they need to pull back on hiring. They need to start cutting their workforce because, look, we did get a great number this morning from the March payrolls report. It's backward looking. But if we start to see stress there, that could actually prompt the Fed to move rates lower. You're not hearing any of that from the folks you talk to?
We're not hearing anything right now. And I think it's because of the foot on the brake and the foot on the gas situation. If anyone says they have enough clarity to make those decisions right now, I would tell you that they know something that 99.9% of the rest of the world doesn't know. So I think we'll start hearing that in probably, I'm going to say, 45 days, 60 days. And again, I think we'll hear it from both sides of the thinking here. Some that may want to cut and others may want to take advantage of the opportunity that this talent is in the market. But right now, there's nothing shocking happening in terms of employment.
Alan, I want to go back to something that you said about these tariff announcements being a shock to the system. Why was this so shocking to the folks you work with each and every day? It was clearly telegraphed by the president when he ran. He told our own editor-in-chief, John Micklethwait, that tariff is his favorite word in the English language. We knew he was going to do this. Why was it still so shocking to the markets and shocking to the executives?
Tim, everyone's asking that question today. It's a smart one. It's a shock not because of what he did. I think it's a shock because people were expecting it to be less significant in terms of scale. So in that, they had to process not the idea that we had tariffs. And I'm not going to comment on whether tariffs are a good idea or not. I'm not an economist, and I don't think anyone knows how this plays out mathematically and in terms of actual market equilibrium. But I think the shock to the system was the scale. And there's shocks to the system frequently, and people get past it.
Hey, one of the things I wanted to ask you, and here we are again, just to remind everybody, since we're so focused on the market, a second day of some extreme selling, S&P down about 5.6%, Dow down 5%, and the NASDAQ 100 also down 5.6%. Alan, the U.S. Labor Secretary earlier spoke to Bloomberg off of the jobs report. That was an upbeat one, and said that this wouldn't be the last positive jobs report under President Trump, and that companies are now investing billions of dollars in the economy. We're seeing the selling because there's nervousness because of the U.S. tariffs, a possible trade war, and then that leads to a U.S. slowdown and potentially a global slowdown. So the president has stressed all the money that will come back into the U.S. economy. Do you and leaders that you speak to kind of buy this idea that there will be lots of investment or more investment in the U.S., that we will see factories built, make things, create lots of jobs, that it will lead to an economic boom? I know what economists say and what history tells us, but what do leaders that you talk to say this? Do they buy this action and this expectation?
I again, not hearing enough to say, wow, there's a big trend here. But what I do hear is, there are places in this country where people could make a reasonable dollar per hour wage that wouldn't be egregious in terms of being competitive and have a terrific quality of life. And certainly that's not necessarily in the big cities. But if we bring in a situation where, free market of sorts starts to see some green shoots in terms of light manufacturing,
right,
then yes, the answer is it could be. And by the way, there's another thing to remember. It's something that Korn Ferry does. It's this notion of upskilling. So, as these jobs materialize, if this particular strategy works, then we're going to have people right now that are in, let's say, lower order jobs that make less per hour, perhaps get some upskilling and be able to go into a light manufacturing opportunity where they could make more. All of this is still speculation.
Okay.
Each of us could argue both sides. I quite frankly don't have a particular bias here. I try to look at it as measured as possible.
20 seconds. Everybody's not screaming recession or stagflation or the end of globalization. Just quickly.
People are worried about stagflation.
Okay.
People are expecting, recession because we've been expecting recession for 20 years. And again, I think we talk about the market. If we look at the market today, I think if you look at the 2-year S&P, today it's still up 35% over those 2 years or so. It's a big number.
Yeah.
So, a lot of the money that's theoretically coming off of people's portfolios today is money that they've, more than earned in returns. And again, if you don't sell today, you don't lose any money, right?
All right. Alan Guarino, thank you so much. Vice Chairman in the CEO and Board Services Practice at Korn Ferry, joining us from the West Coast.
This is the Bloomberg Business Week podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.